Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So if I'm worried about having too much U.S. dollar exposure, here's the formula. 250 grand divided by 11,313 equals your new U.S. dollar amount in quote currency divided by 100. So really what I'm saying is that if the U.S. dollar is down by about 11.6%, dollar versus Canadian, I've lost almost 30 grand here, 29,000. So my new value, of course, the dollar is still going to, U.S. dollar is still going to be worth 250, but relative to someone that, let's say, is in Canada, well, they just lost purchasing power. So in fact, they lost about 11.61% of their purchasing power. So that's the way we're looking at it. We're talking about purchasing power, and someone that had the ability to hedge it actually lost about 11.61%. So I just did sort of a simple algebraic equation. 250 divided by 1113 equals X over 10,000. And then where did I get 10,000 from? It's 100 times 100, because I'm saying that CDD is going to 100. So again, that's just approximation, but needed to know. Whoops, excuse me, on where it might go to. Okay, here. So here's a table. Hope you follow this, because I spent quite a bit of time on calculating all this. But remember, this is a U.S. dollar investment. Maybe it's a Canadian investor that was worried about their U.S. dollar money that they had invested here in the United States. So it's dollar goes down to par, so down, of course, about 11% or so. And I'm saying, well, what happens if it gets to 100? Where would these options be at expiration? So I kind of came up with the cost, where I could have bought them on that one day, the value at expiration. What is the 103 put worth if we get to 100? Well, it's obviously 3. The 108 is worth 8, and so on. You can go all the way down, right? It's pretty easy to figure that out. Now I wanted to figure out my value less my cost, because I have to pay a bit of premium to get all these options. So I calculate my value less my cost, and then I multiply by the 22 contracts that I have. So the good part about this hedge, at least in this case, when the dollar sells off and I bought puts, is that I'm bringing in a decent amount of capital back into my account. The bad part is I never get the full amount back. Why? Because I'm paying an option premium that's going to vanish. Some of it's going to vanish. Now, the 123, if I did all the math, I would have lost about $29,000 in my currency exposure. I would have made about $27,500 in my option. So you could see that if I bought an in-the-money option, this gives me my best protection. Best. Problem is, costs the most. You want to see the second best? Second best is the 118. Followed by the second highest premium. And then you could go down and basically so on and so on. You'll see that this one's going to cost you, I'm going to be a little less hedged because I didn't buy as much protection. Remember, these are a way to look at insurance policy deductibles. It's analogous to insurance. So if I buy one that actually has a bigger deductible, well, I'm actually going down, and the 103, I hardly even get hedged, because look at this. I don't get hedged until 103. If it goes only to 100, well, I lost about $25,000 in purchasing power by putting that trade on. So I really didn't even hedge all that much. Now, of course, if it went to 90 or 80, I would have actually started to realize some more benefits of the hedging. So whenever you're thinking about hedging, you have to think about what is your maximum pain level. We all want maximum hedges, but if you want a maximum hedge, you got to pay the most premium. So you're probably not going to want to, you may want to do the 123, but there are a lot of choices. And I tried to make this as succinct as possible, but as you can imagine, it becomes a little esoteric because I had all these columns to figure out what is the option worth, what did it cost me, how many options do I have, which in this case was 22 when I calculated all that. And then I basically came up with the total net loss with hedging. And as I said, if I was fully certain that I really did not want to have U.S. dollar exposure, the best thing to do would be to probably sell it in the spot market and walk away from the whole trade. The reason I do this is because I'm willing to live with some of the risk. And of course, and you maybe think that the dollar may even rally. Again, this is one scenario that the dollar would sell off. So I hope that helps. Now, of course, there's two sides to every coin. Even though we've seen the dollar sell off significantly since March of this year, there is another flip side to that. What could happen? The dollar, let's say it gets a risk bid like it did in 2008. Why couldn't the dollar rally significantly? I know that that's really not a popular theme right now, but at some point, that is very possible. We saw it happen in 2008. So if somebody had, whether you're an American, let's say, it's one way to look at it, and you had investments in Canada, and you were concerned that maybe the American dollar would catch a bid, people would be start to be a little bit more worried about risk. So risk appetite, we've seen that, or an aversion to risk would probably help the CDD calls. So if I looked at someone that had money invested in the Canadian and the Canadian was going to weaken, I might want to hedge. So again, just turning it around, I looked at the similar strike prices. Again, nothing magical about the 6-month time frame, but decided, well, let's just use that. And you'll notice now, though, that the higher strike options are actually cheaper. Why? Because it's a call option. So before we saw put options being the cheaper ones were the out of the money, the downside puts. Now the upside calls are cheaper because now it's the right to buy rather than the right to sell. So if I wanted to buy something that had the most value, well, I would be buying the 108 call. Problem with the 108 call is that it's costing me a lot more money than, let's say, the 113, 118, or 123. So essentially, as we move up in strike, the costs are going to be reduced. So I hope that helps. I drew that little line there. Reduced as we go up. So let's go through and say, okay, what happens if CDD? What happens if the CDD moves to 126.26? And I just said, okay, what happens if it moves up about 11.61? So almost the same amount. And why couldn't that? Could definitely happen if we go back. I mean, we look at where it was, and we came from 128. So obviously 126 is possible. So 126, now if we're doing that, we're concerned with a risk bid, and the dollar is going to rally all the way back to, let's say, 126, 2027, 128. So now we're looking at calls. So to hedge our position, we're going to be looking at call options.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.